Welcome back to Money Mentor Zone. In episode 1, we learnt what same day loans are and how they work. In episode 2, we compared 10 actual lenders operating in USA. In episode 3, we did a deep dive on the three main types: payday loans, installment loans, and line of credit. In episode 4, we exposed the hidden fees lenders don't tell you about. In episode 5, we helped you figure out whether a same day loan makes sense for your situation. And today, in episode 6, we are finally covering something I have been promising since episode 1. Because here is the truth: before you even consider a same day loan, there are 7 options you should try first. Some of them might surprise you, some of them could save you thousands of dollars, and all of them are safer than walking into a payday lender store. Let's get started. Alternative number 1: credit union loans. If you are not a member of a credit union, this might be the single best financial move you make all year. Credit unions are not for profit organizations owned by their members. That means they are designed to help you, not to make money off you. And many credit unions offer small dollar loans especially designed as alternatives to payday loans. The National Credit Union Administration, that's the government agency that oversees federal credit unions, actually created something called Payday Alternative Loans, or PALS. These are small loans, typically between $200 and $1,000, with loan terms of 1 to 6 months. And here's the kicker: the maximum APR is 28% with an application fees of no more than $20. Compare that to payday loans. At 400% APR on a 300 loan, a payday lender might charge you $45 in fees for 2 weeks. A credit union PAL about $6 in interest for the same period. Some credit unions even offer PAL2 loans, which go up to $2,000 with terms up to 12 months, still capped at 28% APR. Now, there is one catch. You usually need to be a credit union member to apply. For PAL1 loans, you typically need to be a member for at least 1 month before you can apply. But some credit unions have immediate eligibility for certain products. Membership requirements vary. Some credit unions are based on where you live or work. Others are open to anyone who makes a small donation to a partner organization. It's worth checking what's available in your area. For example, Oregon State Credit Union offers a payday advance loans with a 27% APR, no loan fee, and amounts from $50 to $500. Fast approval, no credit report required. That's what a fair loan looks like. The verdict: if you can join a credit union, this should be your first stop before any same day loan. The rates are lower, the terms are fair, and they actually want to help you succeed. Now I want to spend a little more time on payday alternative loans because they are so important and so misunderstood. The NCUA created PALS specifically to give credit union members a safe, affordable alternative to high cost payday loans. And they build in protections that you just don't get with payday lenders. There are actually two types. PAL1 loans are for $200 to $1,000 with terms of 1 to 6 months. You have to be a credit union member for at least a month before applying. PAL2 loans introduced in 2019 go up to $2,000 with terms up to 12 months. And here's the important part with PAL2. You can often apply immediately, no waiting period. The NCUA also put in strict rules to prevent the kind of debt traps we talked about in episode 1. You can't roll over these loans. Federal credit unions can't lend more than one PAL at a time to any borrower, and you can't get more than 3 PALs in any 6-month period. These rules are designed to protect you from falling into a cycle of debt. Here's something else interesting. By December 2023, 16 states had actually banned payday loans entirely, but the demand for short-term funding didn't disappear. That's why PAL have become so important. They fill the gap with a product that's actually affordable. The verdict. If you are already in a credit union, ask them about PALS. If you are not, consider joining one specifically for access to these loans. The 28% APR cap is still high compared to a good credit card, but it's a fraction of what payday lenders charge. Alternative 3. Employer advances and earned wages access. This is one of the fastest growing alternative and for good reason. Instead of borrowing money you don't have, you are accessing money you have already earned but haven't been paid yet. Apps like EarnIn, which we talked about in episode 4, let you access your wages as you earn them. With EarnIn's cash out feature, you can get up to $150 per day with a maximum of $750 between paydays. No interest, no mandatory fees, and no credit check. If you need money instantly, there's a small fee, typically around $3.99 for lightning speed transfers. But if you can wait 1 to 2 business days, it's free. Tips are optional. Other companies are getting into this space too. Self Financial recently launched Self Cash, an earned wage access product available in 26 states. They offer advances with no interest, no credit check, and no late fees. According to PYMNTS intelligence, 67% of consumers live paycheck to paycheck, the highest rate since 2020. That's why earned wage access has become so popular. It's not borrowing, it's just getting your own money earlier. Some employers also offer formal payroll advance programs through platforms like PayActive or ADP. You will need to check with your HR department to see if this is available. These programs are integrated with your employer's payroll system, making it easy to request funds. If your employer doesn't have a formal program, you could try and asking them directly for an advance. Review your employee handbook first or ask HR about the possibility. Some employers are willing to help, especially if you explain the situation. Alternative 4. Borrowing from family or friends. I know this can be uncomfortable, But let's be honest about the trade off. A family loan typically comes with no interest, no fees, and flexible repayment. Compare that to 400% APR from a payday lender. Three rules if you go this route. 1. Put it in writing. Even a simple text protects both sides. 2. Be realistic. Don't promise 2 weeks if you need 2 months. 3. Communicate early. If you will be late, tell them before the due date. The verdict: cheapest option available. But treat it with seriousness. The cost of default isn't financial, it's personal. Alternative 5. Negotiating with your creditors. This is the option most people don't even think about. And it can be incredibly effective. Pick up the phone and call who you owe. The CFPB explicitly recommends this. They might offer a payment plan, an extension on your due date, waived late fees, even a reduced settlement amount. Medical bills are especially negotiable. Utility companies often have assistance programs. Credit card companies may offer hardship plans. Alternative 6. Community Assistance Program. This is free money. You don't pay it back. Across the country, thousands of local programs provide emergency help for housing, utilities, medical bills, and more. Programs like San Francisco Season of Sharing or Minnesota Emergency Assistance exist specifically for situations like yours. How to find them? Call 211. It's free, confidential, and connects you with local resources, or search emergency assistance plus your city or county name. The verdict: this is free help. Before you borrow, check if you qualify. Alternative 7. Building an emergency fund. I know this doesn't help you today, but it's here, so you never need this video again. Start small. Even $10 per week is $520 in a year. Enough for most emergencies. Set up automatic transfers from checking to savings. Out of sight, out of mind. Aim for $500 first, then $1,000, then 3 months of expenses. The verdict: today's emergency is why you need an emergency fund. Start building one now. So next time. Here's what today's episode is not saying. We are not saying borrowing is always bad. We are not saying same day loans are never the answer. What we are saying is, before you borrow, try these 7 alternatives first. Most are cheaper, many are faster, all are safer.